I save in gold, and so I've been a consistent gold buyer, almost irrespective of the chart. I speculate in silver, and I speculated in silver because it was hated, and it isn't hated yet. And the silver stocks are cheaper than silver is, which is ironic. If the silver price increases, the silver stocks will probably increase.
I doubled the gold, sold the silver, and increased and took a new position in miners. And the reason why is because I don't like in this environment, macroeconomic environment, where the second derivative of inflation and growth are slowing, silver tends not to do as well as gold. Doesn't mean that means you just sell your silver and get negative on it. I'm not saying that. I'd rather put my precious metals resources towards gold and the miners right now.
Gold is quietly regaining attention as investors reassess risk. Precious metals are becoming a focal point in an uncertain economic landscape. Rule and Michael Pento discussed their current views on gold, silver, and mining stocks during a wide-ranging conversation about investing strategy. Rule explained that he saves in gold and has remained a consistent buyer, largely regardless of short-term chart movements. He views gold as a reliable store of value and continues allocating capital toward it. Regarding silver, he said he previously speculated in the metal because it was widely disliked, yet believes it is not truly hated today. Pento emphasized the importance of the broader macroeconomic environment. He argued that when inflation and economic growth are slowing, silver often underperforms gold. As a result, he shifted exposure by increasing gold holdings, reducing silver positions, and establishing new investments in mining companies. Both investors highlighted valuation opportunities in miners, noting that some silver stocks appear cheaper than the underlying metal itself. They suggested that rising metal prices could benefit select mining shares, while maintaining a disciplined long-term investment approach. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
I save in gold.
Okay.
And so I've been a consistent gold buyer, almost irrespective of the chart. I speculate in silver, and I speculated in silver because it was hated, and it isn't hated yet. And the silver stocks are cheaper than silver is, which is ironic. If the silver price increases, the silver stocks will probably increase. The silver stocks are priced at a discount to today's value of silver. So if silver trades sideways, the silver stocks will likely outperform silver. Paradoxically, if the silver price declines, because the valuations in the silver mining companies discount lower prices, they'll probably decline less. So when I think about those two factors, I'll reflect my speculative instincts in the silver market in the silver equities rather than in silver itself. Certainly, I believe that 10 years from now, the gold price will be much higher, at least in nominal terms, than it is today. So I'm a structural buyer. As a structural buyer, lower prices suit me. The truth is that if you took a $1,000 move in gold either direction, $1,000 higher, I wouldn't be a seller. $1,000 lower, I'd be a big buyer. Lower prices are in my interest because I'm a structural gold buyer. Some of your subscribers may feel very differently. Gold stocks, the way I value them against their net present value, assuming that their production is sold at today's spot price, are as cheap as I've seen them in 40 years. It wouldn't surprise me to see them get cheaper, but I don't care. Sometimes stuff is cheap enough. I need to say, by the way, I am delighted that this market malaise comes in timing that's coincidental with our conference. It would be embarrassing to be at the podium next week and tell people that I had selected a great composite of mining shares, but they were all too expensive to buy. The truth is that when you work hard on curated content, it's lovely when that curated content occurs simultaneously with reasonable entry points. So I'm delighted by that chart. Market behavior is interesting in terms of timing, and perhaps because I ignore technical analysis, my timing is usually lousy. But the truth is, I've made money over time. If I have an entrance that has to do with value as opposed to momentum, my exit takes care of itself. I guess I wish after 50 years I had known more about technical analysis. But the truth is that fundamental analysis, the amount of time it takes me to do net present value calculations and net asset value calculations, takes up all my time. I don't have time to learn a new skill. That's why folks like you are in the Rule classroom, so that we can bring different expertise to bear on the same challenges.
I doubled the gold, sold the silver, and increased and took a new position in miners. And the reason why is because I don't like in this environment, macroeconomic environment, where the second derivative of inflation and growth are slowing, silver tends not to do as well as gold. Doesn't mean that means you used to sell your silver and get negative on it. I'm not saying that. I'd rather put my precious metals resources towards gold in the miners right now, and that's what's paying off, especially in the miners, because you think about what they're pulling out of the ground is getting more expensive because the specter of rate hikes is fading quickly, very quickly. But also the energy that they use to produce the metal, their input costs are coming down rather dramatically. So I think the miners are a huge win right now. When they were just being dumped. Where in this market can you find stocks trading at 14, 15 times earnings with a very robust earnings picture? I don't see anything out there like that, and that's why.
And growth
in earnings, growth in revenue, cheap, and when you get right down to it, Kai, and we could talk about this a little later in the program. I mean, the idea that the Federal Reserve can actually shrink its balance sheet innocuously and raise interest rates, making interest rates in a real sense positive, is just ridiculous. Not with the amount of debt that we have. We have over financialized this country. In fact, most of the entire planet is over financialized. If you ever really had a regime of positive real interest rates and a shrinking Fed's balance sheet, you'd crush asset prices, crush the economy. And you wouldn't be looking at a recession. You'd be looking at a depression rather quickly. Usually in times of crisis, the U.S. dollar gains a bit. I expect that to happen again temporarily when we do hit with the credit crisis. But I think on the other side of that, I would expect dollar weakness like we've never seen before. The dollar to crack completely, especially against hard assets. The dollar and the Treasury complex to crack simultaneously after the next crisis is over. But right now, let's just talk short term, which is I manage money. I don't manage money according to theories and hypotheses. What could happen a decade from now or whatever. What's happening now is the dollar had been strengthening on the misguided hypothesis that the Fed was going to be hiking rather aggressively this year. And what you see now is that the Fed, I believe, you're going to get a lot more evidence of a quiescent, or at least let me just be specific. The second derivative of inflation falling from 4.2 back towards 3%, which would take rate hikes off of the front burner. And that means that you're going to see a weaker dollar, which is great for commodities in general, especially precious metals. Not so much base metals, not so much energy, but precious metals, in particular gold. Because gold loves recessions. Because gold loves it when nominal rates are falling and real rates are falling. And that's what I see happening.
Gold and silver continue to attract investor attention for long-term wealth preservation and opportunities in the precious metals market. While gold is often viewed as a strategic store of value during economic uncertainty, silver offers a unique combination of industrial demand and investment potential. Mining stocks also remain an important area of interest, as their valuations can sometimes diverge significantly from the prices of the underlying metals. Market participants frequently analyze production costs, asset values, and future price expectations when assessing sector opportunities. Periods of market weakness can create attractive entry points for investors who focus on long-term fundamentals rather than short-term price movements. As inflation concerns, currency trends, and global economic conditions continue to evolve, precious metals remain a key topic for those seeking diversification and portfolio resilience. Understanding the relationship between metal prices and mining company valuations can help investors make more informed decisions and identify opportunities that may be overlooked during broader market volatility. Let's get back to the interview.
I sold because I owned silver in a speculative account And my reason for owning silver was that when it became an unhated asset, it would recover in price. But it didn't recover. It went hyperbolic. And in this particular case, that chart does explain my timing. Did I sell anywhere near the top? No. Did I take a great big fat slug out of the middle? Yes, which is the best I can hope to do. When you have a hyperbolic up move, uh, which is demonstrated so well here in this chart, they almost always reconcile themselves down. The Canadians call that a hockey stick graph. And the backside of a hockey stick is just as steep as the front side, just a lot less fun if you're wrong. If I'm in an asset class and I see a chart that looks like that, I'm a seller. If I desire to be in an asset class where I see a hyperbolic down move, I'm often a buyer. I didn't sell because necessarily of that hockey stick graph.
We have never seen anything like this in the history of the United States or in the history of the planet Earth. This is the most deformed, overpriced market, and I say market, I mean bond market, housing market, and real estate market, stocks, real estate, and credit that we have ever seen or ever imagined. And the reason why we got here. So for an example, total market cap of equities as a percentage of GDP is 235%, which is absolutely unimaginable just a few decades ago. Usually that metric is around 90%. We're way over double where we should be. And again, I always hasten to add this too, because people say, well, that metric doesn't really matter anymore. Well, you don't like price to sales either. You don't like the Cape-Shiller PE ratio. You don't like negative risk premiums. But for people to say that ratio doesn't matter anymore, use GNP if you don't like GDP, gross national product, which all the things that we produce here and abroad. I got to tell you, no matter how you look at that metric, it screams, oh my God, how did we get here? And the reason why we're here is because we've never before had a central bank that was willing to print trillions upon trillions of dollars. That's not exaggeration. So we're up since 2007. The Fed's balance sheet increased by well over $8 trillion at its peak. What does that mean, the Fed's balance sheet? Does that mean anything? That's high-powered money. It's part of the base money supply. It forms the foundation of the broader monetary aggregates. That's why you see M2. They don't publish M3 anymore. Shadow Stats does, but monetary aggregates they just ripped, to the thermosphere. And you sit around and wonder, why is consumer sentiment so bad? Why can't people afford to buy a house? Why is the economy not functioning well? Why are food lines and soup lines and bread lines and at record levels, and record default rates on auto loans and student loans and credit card loans? The delinquencies and defaults are surging, and this is all laid at the feet at a central bank that is facilitated with alacrity the insolvent condition of the Treasury, the business cycle. We will have another recession, and I think the problem is going to be in credit, and the nucleus of that problem is going to be in private credit, private equity, and now we see this AI bubble where these companies are now borrowing hundreds and hundreds of billions of dollars and throwing it at AI infrastructure. And I think that's going to be a huge problem. I can't tell you the date, and I know it's not now, but when it happens, you'll see interest rates spike, and then the Fed's going to have to come and do something about it. The question is, will they be successful? Because again, ramping up the printing presses and issuing trillions of dollars in debt. We always pulled ourselves out of a problem by using the government's balance sheet. That's how we rescued stocks in 2000 and real estate in 2008. We just massively releveraged the government's balance sheet. When we do that again, does that break the dollar, and does that break the confidence in the sovereign, in the Treasury bond market of the United States? I think the odds are very high that that happens, and then you will have interest rates spike out of control.
Markets have a way of rewarding patience and punishing emotion. The biggest gains rarely come from chasing excitement at the peak of a trend. They come from understanding value, managing risk, and recognizing when expectations have moved too far in one direction. What makes investing difficult is that the crowd often feels the most confident at exactly the wrong time. When optimism becomes extreme, discipline matters more than conviction. And when fear takes over, opportunities can begin to appear where few people are willing to look. The goal is not to capture every dollar of a move or predict the exact top and bottom. Consistent investors focus on probabilities, protect their capital, and stay prepared for changing conditions. That approach may not generate headlines, but it tends to survive market cycles far better than momentum-driven speculation. As always, successful investing is a long-term process built on patience, research, and rational decision-making. Staying grounded when markets become emotional can make all the difference over time. If you enjoyed this analysis and want more insights on investing, precious metals, market trends, and wealth preservation strategies, be sure to like this video, subscribe to the channel, and turn on notifications so you never miss future updates.